get anything that's actually going to tell us the future, but the most immediate things in the background are things like this: the St. Louis Financial Stress Index, which does show the greatest amount of stress in the financial sector over the past couple of weeks since the pandemic, and before that, the great financial crisis. Now, these numbers only go through the 15th, so we'll be waiting today at the end of the day to get an update on whether financial stress has come down or not. And then you have the question of what's happening with banks. And as Neil Dunham was saying, and you quoted him, it's either a bank crisis or it's not. Right now, so far, it's not. We're looking at lending there from all banks and from small banks. And as you can see, not only have they held up, but last week they rose. So we'll see if that continues this week when we get the data on that at about 4:15 on Friday. We'll see what's happening with the banks, and we will see if we are having a crisis or not. So the Fed speak is going to have to depend on reading the tea leaves of these more coincident indicators than on looking backwards at things like PCE on Friday, as important as that'll be to traders.
Mike, you and I have talked a lot about whether policy is truly in conflict. I think a lot of people have written about that over the last couple of weeks. Seth Carpenter at Morgan Stanley totally disagrees. Mike, you wrote this over the weekend. Central banks are deliberately tightening financial conditions in order to slow their respective economies and thereby bring inflation down. What the bank's disruption does, however, is make it harder to calibrate the correct degree of tightening. So, Mike, it's not that policy is in conflict per se. It just makes the calibration of policy more difficult. Do you have sympathy with that view?
Absolutely. And that is something that Jay Powell talked about in his news conference, and the Fed officials have been talking about since, that they know that bank lending may tighten because of the bank issues, but they don't know by how much. And the estimates from Wall Street firms are all over the lot, from 0.3% to 1.5%. So at this point, they kind of have to watch and see. And that's why it's going to be a game time decision for them next time on rates, because they aren't going to have a really clear picture of how much tightening there's going to be of credit and how that's going to affect lending.
Not by early May, not based on what we've seen so far. Mike,
no. Thanks
for that. Mike McKee, thank you. Priya Misra, I wanted to come to you on that. I'll read that quote again from Seth Carpenter at Morgan Stanley. Central banks are deliberately tightening financial conditions in order to slow their respective economies and bring inflation down. What the bank's disruption does, however, is make it harder to calibrate the correct degree of tightening. Now, just 3 weeks ago, Priya, we were talking about no landing.